Imagine there's an acre of agricultural land. The current price of the land is 5 lakh. You think a new highway is going to be built nearby which will increase the land's value to 20 lakh. You want to make sure you can buy this land at the current price of 5 lakh if the price shoots up later. But instead of buying it right now, you make a deal with the landowner. You pay the landowner 50,000 rupees as a premium. This is like a fee for making the deal. In return, the landowner gives you the right but not the obligation to buy the land at 5 lakh anytime in the next 6 months. This is called an option. Now, there are two possible outcomes over the next 6 months. The highway is built and the land price rises to 20 lakh. The price goes up as you expected. You use your option to buy the land at 5 lakh even though it's now worth 20 lakh. This means you now own the land at a lower price than the market value. Your profit would be 20 lakh minus 5 lakh is equal to 15 lakh. Subtract the 50,000 premium you paid earlier and your profit is still big. The highway is not built and the land price stays at 5 lakh or falls. The price doesn't go up or it goes down. You can choose not to buy the land because the price didn't increase. All you lose is the 50,000 premium you paid for the option, but you don't have to spend 5 lakh on a land that didn't increase in value. Let us connect this incident with option trading. The 50,000 premium is the amount you pay to have the right to buy the land at 5 lakh. 5 lakh here is the strike price. If the price goes up, you can exercise your option and buy at 5 lakh making a profit. If the price stays the same or drops, you let the option expire and you only lose the 50,000 premium. In the stock market, people do something similar with shares. They pay a premium to get the option to buy or sell shares at a set price based on whether they think the price will fall or rise. That's it for today. Thanks for watching.